Some of the best wealth building opportunities happen during economic chaos. It's a hot take that might make people uncomfortable, but most people are going to be panicking about gas prices, of course, inflation, and whatever headline is trending that they freeze instead of preparing. With everything going on, oil prices are climbing, tensions in the Middle East are escalating, and political decisions are creating ripple effects that could raise the cost of almost everything in the United States, from groceries, construction materials, interest rates, and even rents. If you open the news right now, it feels like the world is on fire. The Middle East conflict, again, oil prices, the political chaos of it all is giving us inflation anxiety. And when people see these headlines or hear about them, they start asking themselves, should I pause investing? Is real estate about to crash, like the housing market? But history actually tells us something different. Economic uncertainty doesn't just create risk, it creates opportunity for the people who are prepared. So today we're going to break down three things. Number one, what's happening, how this could affect the US economy, and of course, real estate, and what smart real estate investors should be doing right now. Not out of fear, but with strategy.
Let's start with oil because oil isn't just about filling your gas tank. Oil is basically the bloodline of the global economy. When oil prices rise, it affects almost everything: transportation, food costs, manufacturing, construction materials. If oil prices spike due to instability in the Middle East, here's what tends to happen in the US. The company pass the cost to consumers. That means groceries go up, shipping costs go up, air travel goes up, utilities, costs can go up. And I think we already seen it. I live in California. It's a pretty high cost of living area, and oil prices are already up as response to the news. If energy costs stay high, inflation tends to stick around longer. And when inflation stays high, the Federal Reserve is less likely to cut interest quickly, which means mortgage rates may rise higher for longer. Violet and I, we noticed that the market has reacted before even the Federal Reserve has taken a stand on what the Fed rate is going to be, because they only meet once a month. The market has taken a stand, and on a mortgage daily news, you can see there's been a spike on conventional as well as DSCR rates. So when talking about construction, for investors, this is particularly huge because oil affects lumber transportation. And I remember when earlier last year, when the fires were going on and we had the unexpected tariffs to Mexico and Canada, that a lot of contractors started raising their prices. This is beginning of 2025, I believe, and that's really increased most of my projects as well. So just like that happened, oil can affect the cost of, for example, roofing materials, asphalt, labor transportation, heavy equipment, and new construction projects now can get more expensive. If you are already trying to get a budget for your rehabs, you have to account for the news, and you have to count how the market responds and what prices may go up now.
We even saw this during like COVID because obviously, like the thing that's happening over there in the Middle East is affecting like the oil, which is like you said, affecting the transportation, affected like shipping. And so, like, there was less lumber available and everything. And then it just like skyrocketed. So, I remember even trying to do like some minor like work on the house. I was like, oh, geez, like it's got so much more expensive. It's already happening. I hadn't locked in my rate yet. Like, dang, I really should have locked it in when we were like at it dropped below 6%. Closing on this property, I have to think about all this wood. So I might just go ahead and order the wood now before it skyrockets because I have a few projects to do on this property, and yeah, it's gonna be rough.
Yeah, this is as of March 14, and I think we both you're in escrow currently. I don't think we mentioned that,
Mhm.
and
Yeah.
your rate went up for the SER, right?
Yes, DSCR.
And then I am on a refinance right now. My rate went up, and I was just talking about it with you from 6.5 to 6.7.
We both usually account for I think we both usually do our numbers at 7% anyways. So, like, when I ran the numbers for this property, I was, like, at 7% in case it goes up. So which it dropped, and we were, like, got a little bit of hope, and then the whole Middle East thing happened, and then bam, like, everything went back up. So, uh, luckily, I accounted, did my numbers at 7%. So I'm still good, still gonna cash flow, not as much as I thought. What does that mean for real estate? Everything's getting pricier. Real estate is going to react to the economic things that are happening, and it does it in a few ways. People still need a place to live, so that means then rental housing is going to come become more important because that's a little bit more affordable than a high mortgage. So you're gonna might see more renters out there because usually with the economy like starts getting hit hard, the rental demand still stays strong because of course if people can't afford to buy a house, they need somewhere to rent. So when you start seeing all these headlines, you're going to get scared. That fear is going to start coming up, and a lot of investors, they want to get rid of some assets to, boost up their maybe savings, or just don't want to be spread out too thin. And so they might sell. So a lot of them might panic sell, or not even panic sell, just like, giving themselves a cushion. So that brings opportunity for you as an investor. You might be able to pick up some new properties. So just be on the lookout for that. Keep your risk in mind and everything else that's going to be pricey. The other thing is that the rents, there's going to be pressure to increase because again, with inflation, of course, everything's going to increase in price. And so this is kind of where there's a little bit of learning how to balance because of course our property taxes are going to go up, insurance is going to go up, the maintenance costs because of the lumber and everything that and the labor that Lynn was mentioning, and the utilities might go up. So then to make up for that, we're going to have to increase our rents. And so you'll start feeling that pressure, and I know, for example, myself, I try to keep things affordable, but I also have to balance making sure I cover my costs and still have some profit to make it worth it to have that rental property. But I think the thing is to just ensure that you are balancing that out because you don't want to price out your tenants because then you won't have any tenants. But let's talk about what smart investors should be thinking about during everything that's going on because you want to think about it strategically, not, panicking, because that's not going to help you, build your portfolio, build wealth. Preparing yourself and having a plan is going to help you out. So tip number one is going to first thing you want to do is protect your cash flow. Again, with the rising costs, properties, within margins are going to be risky. Look at your maintenance and maybe do some preventative maintenance now so in the future it doesn't hit you as hard because it's right now labor is a little bit cheaper and lumber costs, so it hasn't hit us yet. And but in a few months, all of that might go up. So if you have some maintenance that you've been like just holding on to or whatever, just maybe go ahead and take care of that and just prepare yourself for to ride out this economic turmoil. It's a lot of just planning. Just look at your properties and see how you can protect that cash flow. Tip number two, that is to increase your reserves. And we always talk about like always having like an emergency fund for your properties. Most of us, we usually do like 3 to 6 months, but with the uncertainty, maybe increase it to 12 months.
Tip number three, aside, lock in fixed debt when possible. And this is if you like it, lock it. Because we don't know, we're in unstable times, right? And then this is right now, this mortgage interest rates are pretty finicky and pretty reactionary to what's going around in the world. And the 10-year bond market as well. Like, and we just definitely, one of the biggest advantages in real estate is fixed debt. So if you lock the mortgage rate today, the payment stays the same. Meanwhile, rent and inflation may continue to rise over time. And even if they're not rising, they don't go backwards, right? Like rent always goes up or it softens. This is one of the reasons why real estate historically performs well during inflationary periods. It's more of a safeguard as opposed to investing like in something like stocks. The stock market's also currently responding very harshly to what's going on around the world, especially in America. Another tip that I have is avoid over leveraging. And this may be very enticing for you to put zero money down to buy houses with no equity. If you learn about seller financing or even seen our episode on seller financing, go check it out. It's very appealing to go into a property and have zero equity into it because you technically have not put any money down, or you're borrowing the money for the down payment, or you're borrowing the money for the rehab costs. But one of the mistakes I see investors is over leveraging. When you're buying properties with no reserves or with thin margins or with risky projections, instead of focusing on the deals that still make sense, it can be a little messy. So when you're forecasting for your rents, be conservative about your rents. When forecasting for your rates, like Violeta mentioned, like she underwrites for her interest rates of 7%. That is great because even if you get 6.9, you're already winning, right? You already have the zero point 0.1 that you're currently putting in your pocket. And when you're underestimating rehab projects, which it's something that I've done in the past, always overestimate your rehab projects because you can make a deal that would be just not feasible. What is the point of having zero money down in your deal when you're not making any cash flow? At least in my mind, that's not a fair exchange for you.
You wanna have that on your savings, but don't forget that you might have your 401ks or credit cards or whatever, so I have that as an emergency, and you might be tempted to also use that. I know a lot of people will say like, "Oh, don't touch your, like, your 401k," but, like, during emergencies, during these times, like, if it's something that's gonna get you out of a situation where you might lose your rental property, I'm just gonna go ahead and take that loan out on my TSP. I have credit cards that have a pretty high limit, so I know that I'm safe with that as well. So I might not have the 12 months reserves yet. I'm gonna have a plan to pay off those credit cards because they do have like a high interest. And same thing if you end up pulling out your 401k, you have a plan to like pay it off or just eat the 10% in the capital gains on that. So it's a benefit versus, a risk and cost for yourself. If you do find yourself in a situation where like you're struggling with your rental property that has a mortgage on it, don't forget to just reach out to the mortgage company, the lender, and try to see if you could work something out. Most of the time, like I know during COVID, you were able to like reach out and they would reach out, create a plan. Most of the time, they just kind of like lower it and then it just gets added to the back end. So, but if it's going to allow you to keep that property and keep going, just remember that option is out there. Sometimes a lot of people forget about that. You don't have to go ahead and don't wait till like the last minute to where like you're risking foreclosure because then you're gonna make a bad financial decision out of fear, trying to like sell it or whatever, and then some wholesaler's gonna come in and like scoop it up. And when all you have to do is maybe just call the lender and come up with the plan, and you could have just kept that property. Just plan for that and just know all your options.
Given said that, guys, that it is very uneasy times for a lot of people, that means there's less competition, right? And then so when you're looking for a place or a home, and then you have your set of criteria, your buy box, and you know how to calculate for your taxes reassessment, you know how to calculate for insurance. It's the part that's easy is to calculate your mortgage payment. The part that it's going to be fixed. Everything else is like very much in the air. But if you have a narrow set of criteria, if you know you're going to purchase a home, there's 3 bedrooms, 2 bathrooms, and these 3 zip codes and this market, and you've been spending time on that, then you know you're going to feel how uneasy people are because your days of markets are going to change. Your days of markets are going to change from like 30 to 45 days or to 60 days even. That lets you know that there's been a change in the market. People are scared to buy. People are uneasy to set that, to like sign that contract, to negotiate for the contract. Maybe they're falling out of escrow. You're in tune with your market. You talk to realtors, you talk to property managers, and then you look up at the news. You need to be obsessed with your market because every single little detail that changes, it's going to be where you get your in, where you find more information, where you get your opportunity. So even though everything is out in the air right now, there is still space for opportunity. Look at 2020 when we had COVID. Interest rates fell, right? So just wait for the opportunity. Look at your market every day. Make sure you run your numbers. Make sure you're conservative. Make sure you have reserves. And make sure you tune in and watch our episodes.
If you're a millennial, like we've been through unprecedented times, like at least 20 times by now. Like it's always something and that we've gone through and we've made it through and our parents have too. I know my parents, had to go through the whole 2008 thing, but they managed to buy a house through seller financing. They were still able to find an opportunity there and they were able to survive. My immigrant parents that had no clue about, the economy here in the US, they made it through. Other people have made it through of like don't let the fear overtake you and cause you to make a poor financial decision. Create a strategy, look at where you are right now with your properties, with your finances, create a plan for reserves for, having the access to money, whether that's credit cards, 401k. And remember that this is a long-term gain. So think about it like same thing with the stock market is right now turmoil, chaos, stocks go up and down or whatever. When you zoom out, you're going to realize that's kind of like a small portion of your 10, 20, even 30-year strategy. Lynn and I, we both are in it for the long term. It's a struggle right now, but at the end of those 20, 30 years, we're going to see that that was just a small little hiccup. But overall, we made money and build our wealth throughout that time. If real estate investing is something that you are interested in, I do have a 5-day rental, like property crash course. It's free. I'll have it linked down below. If you're interested, it's going to give you just like the basics to get you started and out the door to go find a property. Other than that, let us know any comments, questions, concerns in the comments down below if you're watching this on YouTube, or hit me up or Lynn on Instagram. Other than that, we'll see you in the next episode. Bye.
Bye, guys.